So you got pre-approved for a mortgage and you're feeling great. You're out shopping for homes, you're making offers, and then 3 weeks before closing, your lender calls and says that your loan is denied. And it happens way more than you'd think. About 1 in 10 mortgage applications get denied, and a huge percentage of those denials happen after pre-approval because of something the buyer did between getting that letter and sitting down at the closing table. I'm going to walk you through the 5 most common mistakes that I see kill deals, and honestly, most of them are completely avoidable. And stick around because the last one I'm going to share is the one almost nobody talks about, and it might be the most dangerous of all. Quick note, if you're buying a home in the next 90 days and want to make sure that your file is bulletproof, before you start, there's a link in the description below to schedule a free strategy call. I'll walk you through exactly what to do, what to avoid between now and closing. Most lenders give you a rate. I'm going to give you a strategy, and today is no different. Okay, so the first one, and this one catches people off guard more than anything. Large deposits that you simply can't explain. I had a borrower last year. Great file, solid income. We were cruising toward closing. Then his mom gave him some money to help with moving costs. Just transfer it right into his checking account. No gift letter, no documentation, no paper trail. The underwriter flagged it immediately. Here's the thing most people don't realize is that your lender actually is required to review your bank statements, and any deposit that looks unusual compared to your normal paycheck deposits have to be sourced and explained. And if you can't document where that money came from, the underwriter can't use it. And worse, it raises red flags about your entire financial picture. The fix is simple. If anyone is giving you money, or you're moving funds between accounts, or you're selling something and depositing the proceeds, tell your loan officer first. Every single time. Now, the second mistake, and this is the one that I personally see blow up the most deals, is opening new credit. I had a couple a few years back, and this blew my mind. They were closing 2 weeks later on their first home. They went to a furniture store and got excited about furnishing the new place and opened a store credit card to finance a living room set. Now, that one decision dropped their credit score enough to push them below the threshold for their loan program and added a new monthly payment to their debt-to-income ratio. We almost lost the deal entirely. Now, here's what people don't understand is your lender does a second credit check right before closing. It's called a soft pull, and it shows any new accounts, any new inquiries, any changes. You might think a furniture card is no big deal, but in underwriting, it absolutely is. So, no new credit cards, no financing, no buy now, pay later plans until you have those keys in your hand. What I'm about to explain is the part that changes everything for most buyers who talk to you. And that third mistake is really just buying a car or any major purchase during the loan process. And I'm not just talking about financing. Even paying cash for something big can hurt you. And if you finance it, you've just increased your debt to income ratio, which is one of the main numbers underwriting uses to determine if you can afford your mortgage. Now, if you pay cash, you've just reduced your reserves, and lenders want to see that you have enough money left over after closing. Either way, you lose. Now, I tell every single borrower I work with the same thing. Pretend your money is frozen until closing day. If you want to help applying this to your specific situation, schedule a free strategy call. The link is right below this video. Now, I'll personally look at your numbers. I'll tell you everything, where you stand, exactly where you stand. Fourth mistake, changing jobs. Now, let me be real. I know sometimes life happens and you can't control this one. But if you have a choice, do not switch jobs between pre-approval and closing. Even if the new job pays more, your lender verified your employment and income at the time of pre-approval. And if you switch, they need to re-verify everything with the new employer. They typically need at least 1 or 2 pay stubs from a new job. And if you've moved into a completely different industry, that can make underwriters very nervous about income stability. Now, I had a borrower who got promoted, technically the same company, but the new role changed his pay structure from salary to salary plus commission. That commission income couldn't be counted because he had no history of earning it, and suddenly he didn't qualify anymore. Now, if a job is on the horizon, call your loan officer before you accept it. We can usually work around it if we know in advance. Now, that fifth one that we talked about, and I saved this for last because it's a silent killer, co-signing for someone else. A family member asks you to co-sign a car loan or a student loan, and you think, well, I'm not the one making the payments, it's no big deal. Wrong. When you co-sign, that entire debt shows up on your credit report as your obligation. The full monthly payment gets factored into your debt to income ratio. And if that pushes your debt to income ratio over the lender's limit, your loan gets denied. I've seen this happen with parents co-signing for their kids, with siblings helping each other out. The intention is always good, but the timing is devastating. Here's the positive flip side to all of this, because I don't just want to scare you. Smart buyers who close smoothly all do the same things during this window. They keep their spending boring and predictable. They stay at their same job. They respond fast when their lender asks for documents. And most importantly, they communicate. Anytime something comes up, a bonus check, a freelance payment, a question about a family member co-signing, they pick up the phone and they call their loan officer before making the move. That one habit, just asking before you act, prevents probably 90% of the problems I see in this business. If this helped you see your situation differently, do two things. Schedule a free strategy call using the link in the description. I'll walk you through exactly what to do and what to avoid between now and closing. And then hit the subscribe button so you don't miss what's coming next. Have a good one.